Today we are into the fifth unit of Block 2, Introduction to Business Environment. In the business environment, the financial system is one of the most critical part. So today we will be covering that unit. So Block 2, Introduction to Business Environment, Unit 5, Indian Financial System. So let us first understand the objective of this unit. After completing this unit, you should be able to explain the importance of the financial system, number one. Number two, you can describe the structure and working of the money market and capital market. In fact, these two are the very important part of the financial market in India, beside banking system. So naturally, third, we will come to the outline of the structure of the banking system. And finally, we'll examine the working of the capital market along with its various instruments and intermediaries. So you can understand the financial system, which first will cover the financial money market and capital market. We'll cover actually the money market, then we'll come to the banking system, and then finally we'll come to the capital market. So these three are basically the structure of the financial system. Besides that, there is insurance and other things which we'll cover later on. So let's go to the introduction. In the previous units, we have studied about different theories of economic growth. You remember Hamada growth model and different type of growth models, and have realized that for an economy to achieve higher level of economic growth, and that is the target of every economy, to have the higher level of economic growth and indeed economic development. Growth brings in development. The role of capital formation is indispensable. You might have heard that all the time we are talking about increasing the GDP, that is the indicator, and we have studied about it, the economic growth. Now, capital formation is indispensable, we have mentioned. Now, capital in the economic terminology does not mean money alone. So, one is the monetary capital or fiscal capital. The other is the physical or human capital. Physical capital or human capital is also important to grow. Otherwise, you cannot sustain the economic growth. Now comes to the savings and investment. These are two core components of capital formations. Look at from your end or any individual end also. If you save, then you can invest. That investment grows, your capital grows. Similarly, for a country also, if there is a savings in the country, then country can invest that savings, and that savings investment will bring in growth. So saving is the simplest sense, means a part of income that is not consumed, and when saving is used in such a manner that it gives return in future, it becomes an investment. So if you are not consuming today, if you are keeping saving something for tomorrow, that tomorrow it will yield a better return for you. That is investment. A higher level of savings leads to more investment and capital formations. Now, we call developed countries like America, Germany, UK, and other places, they have a high level of savings, so they can invest. As you have seen now, the AI and other things, where they are investing a lot of money. But we, as a developing economy, we don't have that much of savings to invest. So we have to either borrow, or we have to think of lower level of investment and work with that. So it is important to create savings, mobilize the savings which are in the households, and convert that savings into capital assets, and that will ultimately form capital, more capital. So there are many factors that affect the rate of capital formation in the country, like income level of people. If people are generally poor, they cannot save. Institutional factors, like if you have institution, earlier we had IDBI for industrial development, National Housing Bank, NABARD. So these are the institutional structure which helps you to form the capital. Okay. And also whatever policy government is following. One is monetary policy, which is short term, 1 year, and another is fiscal policy, which the central government follows, which is a long term direction of the economy, how we can grow with a time span of 5 years or 10 years. As you often see that by 2000 such and such will be Vikshit Bharat, another thing. These are the target, which through the policies and short-term and long-term policies and through the help of financial institutions and etc., we are supposed to achieve. Also, there is a question of prevailing rate of interest, population, size of the market. We have a population of 140 crores. Now, this population, may youth is a big part. If they are productively employed, then they will generate wealth and then the country will progress further. But at the same time, if this population, young population, cannot be employed, then it becomes a really problem for the economic planner or the politicians or the bureaucrats how to involve this youth force to generate more income into the economy. Now, financial system and financial market. Actually, financial systems creates a financial market. Financial system consists of a set of institutions, instruments, and market, which brings the savers and the investors to a common platform and provides how savings are translated to investment. Now, principal objective of the financial system or financial markets, actually the system को चालू रखने के लिए, to keep the system running, you need a market. So market does what? They channelize the savings to the investment. So there are in financial market there are two players, namely lenders and borrowers. So when you save in the bank in turn gives it to the entrepreneurs who are ready to set up some small or medium or big enterprises. So they will earn return, and from that return, I will be paying the savings deposit holder, and that's how they will also let their money grow. At the same time, the industrialist also let the money grow, and there is an overall economic growth. So household saves money in the financial system. These funds are channelized in the form of loan or also equity and provided to the borrowers. Banks generally provides loan. We'll come to the capital market where these savings goes as a equity. Now, so if you see the diagram, lenders, individuals and households, they save. Financial system accept the savings. Through the market, it goes as a loan to the borrowers. Borrowers use it for productive purposes, pays the interest, and the system returns the savings money along with the interest. So the individual is also growing, his economic status is improving. At the same time, the borrower, who is the entrepreneur, he is also producing some goods and becoming economically much more richer. So financial markets perform many functions, like first, to connect borrower and lender of funds and to lead to the process of price discovery and determination. I'll explain it. First, to connect borrower and lender. And in a perfect market, to lead the process of price discovery and determination. Some of you are aware that when I talk to equity market, there is a book building method. So I discover the price discovery, ये share का कितना price होना चाहिए, and then only people apply for that. Similarly, when I decide to float, I want to borrow from the market, then I check what is the interest rate people are willing to pay. So then the interest I pay is my cost. That is the price I have to pay for borrowing the money. So that also I discover from the market. So market economy in one way helps you to discover the price for loan as well as price for equity. To provide liquidity in the system by allocation of funds in an efficient manner. Second point is to provide liquidity in the system. Now, naturally, which segment of the economy needs money, money will try to flow there because money will get a better return there. So allocation of funds is possible. Sometimes, as we'll see later on, there are some priority sectors where we need to have fund. So there are other way to allocate fund in those segments. Third is easy access of funds to the borrowers, which in turn reduces the cost of transactions. Now, if borrower has access to the bank, borrower goes to the bank, bank charges 1% fees or something like that, processing charges, and bank can get, borrower can get loan. Whereas if the borrower has to go to the market, he has to pay the merchant banker, the brokers, and etc. The fees becomes more. So what happens? Easy access of funds to the borrower, which in turn reduces cost of transaction. Provides a way for managing uncertainty and controlling risk. So in a way, it provides a uncertainty that money is available or not. You know, the bank are there, market is there from where I can generate money if my project is good, and I'm the person who will be lending. He can also control the risk because he may not lend it to somebody who is going for a more of a speculative venture than of a good venture. Suppose somebody is going for steel producing, he will be producing a lot of capital and other thing, and then he will produce steel, which is always required. But suppose I am trying to produce something, a cold drink, there might be, it's a risky, might be demand, may not be demand, so I may not allocate capital there or something like that. So that is the fourth point, that is provides a way of managing uncertainty and controlling risk. So this is the financial market in general. Broadly, these are the functions they do. Now, financial market has two main components. One is called money market. The other is called capital market. We'll learn about that in the next slides. Now, to tell you something very shortly, money market is a short-term market. This is the money you require for 1 year or you require for less than that, maximum 1 year. Whereas capital market is a market from where you can get money for more than 1 year. That is it. Okay. Now let's go to the money market first. Structure of money market in India. Money market, earlier people used to borrow from lenders, pawn रख के अपना घर में कुछ जिम्मा रख के, and then you get the money and then you put it into the business, etc. That is called unorganized sector. That is called an unorganized sector. There are indigenous banks. Indigenous bank money. What happens is that they operate in small places and other thing. They also keep deposit with you. Your deposit also almost like a bank. They operate without a license. Similarly, non-banking companies are there, simple money lenders and other things, etc. are there. But when I come to the organized sector, there is a regulator, Reserve Bank of India, as well as Reserve Bank of India has other roles to provide funds to the banking system. And through the banking system, commercial banking system, the money comes to the public. The organized sector consists of Central Bank of India or RBI, commercial banks, we will call them scheduled commercial banks, both nationalized as well as private. Further, foreign banks, actually foreign banks ka branches are in India. Cooperative banks, you have seen in various villages or various towns, we have public sector cooperative banks, and we have also urban cooperative banks. Then primary dealers, they deal in government securities mainly. And other financial institutions like IFCI, SIDBI, insurance companies, mutual funds, they are allowed to operate in the money market. So what you can understand from here, it's a big boys market. You have to be a bank, you have to be primary dealer money, your network should be big, and then only you can participate in these markets. Because overnight what happens is that, suppose I am supposed to give a loan, 100 crores loan I have to disburse to Tata Groups. Liquid money I don't have. Tomorrow there will be deposit coming, I will be getting the money by the end of the day. So overnight I can borrow from the market. That market is money market. It's from overnight to 1 year. Okay. So this creates a liquidity So I don't default. I give the loan to the Tata Group in due time, and by the end of the day, I collect deposit from various branches of mine, and then I return the money to the lender. So this is how the money market operates. We'll not go for the unorganized sector, but it is just for your information. This unorganized sector charges very high interest rate, but they do play a role when you come to the, if you have seen somewhere in your heart or the rural market or rural bazaar, sabji mandi or something like that, they borrow money from this type of lender at 1000 or 2000 to buy the vegetables from the village, and 2000 leke they will return 2200. So almost 10% interest for 2 days. So this is the unwanted, but at least the vegetable owner can buy the vegetables and sell and make some money and make a living. So unorganized sector also plays a role, but sometimes they are very extortionist. So RBI is trying to bring this organized sector slowly into the organized sector. Now let us look at the money market. It's a market for short-term financial assets. I have earlier told you what is financial asset. If you hold cash at your home, then it is cash balance in your home. But the moment you put the cash into the bank and get a fixed deposit receipt, that fixed deposit receipt becomes a financial asset in your hand. So this is why when you save or invest somewhere, in return you get financial assets. So these financial assets are close substitute for money. Short term implies period less than 1 year, and close substitute of money referred to those financial assets that can be converted to money with minimum or no transaction cost or without loss in value. I repeat it again. Short term implies a period less than 1 year, overnight to 1 year. Close substitute of money referred to that financial assets can be converted to money with very little cost or no cost and no capital loss of value. Now, what is the objective of the money market? To provide equilibrium mechanism between short-term surplus and deficiencies. State Bank of India has a lot of money, Canada Bank has less, so Canada Bank can borrow from State Bank of India. Maintaining liquidity in the system, that is what, where money is not there, money flows there. Providing access to short-term funds to borrowers at minimum or realistic cost. Suppose mutual fund where there is a demand for withdrawal. Mutual fund has option to sell securities, or they can borrow from the market because they know they will be getting some deposit coming. So they can borrow from the market and redeem the unit holders. So this is called providing access to short-term funds to the borrowers at a minimum or realistic cost. To enable the central bank of the country intervention to influence and regulate liquidity in the economy. What has happened? RBI can intervene and RBI can inject liquidity. Inject liquidity matlab RBI can bring in cash in the market if there is less cash in the market. Suppose there is a rainy season and there is a farmer's about demand to buy the fertilizer, etc., etc. RBI can give loan to the banks. Bank in turn can give loan to the farmers. And at the same time, when the season is over, and there is a methodology, RBI can ask the banks to return the money so that the liquidity in the market is reduced. Now, what are the different type of instruments in the money market? Treasury bill, call market, sorry, commercial papers, commercial bills, certificate of deposit, money market mutual fund. We will discuss this in brief. Now, treasury bills. Treasury bills actually Government of India borrows through RBI. It's in the nature of promissory note. They are of different duration, 91 days, 182 days, 364 days. So if the bill face value is 100, it will be issued at 98 or 96. Suppose it is a 364 days treasury bill. Face value is 100. I will issue it at 94. That means if I am investing 94, I will be getting 100. So 6, it little more than that percentage will be my return. So that is the implied interest rate in that treasury bill. That is why sometimes these are called zero coupon securities, yield no interest. The main feature of treasury bills are they are negotiable instrument, highly liquid in the sense anybody can buy or you can sell at any time and get money in return, and they are secure because government of India is behind it. Okay, but there is no yield, and but there is assured yield. Call market. Now suppose, as I gave an example, banks are collecting a lot of money, and we have an understanding that banks have all the time liquid money. Bank also take the money and bank also invest in other things. So suppose bank want to give loan 10 crores or 20 crores, bank may not have the liquid money to transfer. So bank overnight can get call money. That is, bank will call up which bank has surplus fund. So they can lend them for a day or for fortnight. So 1 day to fortnight. Money at call, it is called. You don't need any collateral security, good faith of banks, because if you fail once, nobody will give you loan. Major players in the call market are banks and primary dealers. The interest rate payable on call loans is known as call rate. So what happens is that when there is a supply of money is less in the market, you can understand call money rate will go up because all the banks will be having less money. So only if they get higher interest, they will lend it. But if there is a lot of money, everybody is interested to give loan, so interest rate will come down. So this is a call market, absolutely a place to play by the bankers and primary dealers. Of course, insurance companies and other things can borrow from here, that's it. They cannot lend. Third, we come to the commercial paper. Now, this is a promissory note issued by unsecured promissory note issued by the corporates. Minimum denomination can be 5 lakhs or multiple thereof. They need to get a rating from, I'll come to the rating part later on. This is also, I told you 5 lakhs, it will be discounted, the 4 lakh 50,000 maybe, I'll be issuing it. That means 50,000 divided by 4 lakh 50,000, 9% will be my return or something like that. It's just an example, not a clear case. They can be issued in denomination of 5 lakhs or multiples thereof. They're issued in the form of promissory note. Promissory note, I will come to the right definition. For a simple understanding, it is a commitment by the borrower to pay in the due date the full amount. CPs are issued for minimum 7 days to a maximum of 1 year from the date of issue. Rating, there are different rating agencies approved by SEBI. It has to be rated by SEBI approved rating agency. Rating can be A2, A3 minimum, and top tier companies have A1 plus rating. So depending on the rating, your interest will be there in the market. Suppose I am my rating is top class rating. I am SBI, but I'm sorry, I am Reliance Industries. I want to borrow money for the market. My rating is AAA or the A1 plus. I can get money at a lower interest rate rather than a company say Marico Industries, which has a rating of A2 or A3, A2 perhaps. They will be paying a little higher interest rate. So this is a thing, and also SEBI says if your issue size is more than a particular amount, you should be rated by at least 2 rating agencies. So what do you understand? It's a promissory note. Minimum is 5 lakhs and multiple thereof. It should be minimum for 7 days, maximum 1 year. It should be rated, and depending on the rating, it should get the interest rate. And finally, if it is depending on the size of the issue, the rating has to be done by 2 companies at least. These are all to be rated by SEBI recognized rating agencies. So commercial paper we have done. Now commercial bills market. First I will tell you what is commercial bill. Suppose I have exported something to US. I have raised a bill. Now I will get the payment after 90 days from the American party. So this is a trade bill or foreign bill, you can say. Similarly, there are trade bills. If it is suppose why Tata Jindal Steel has supplied steel to the railways, a railway will pay after 6 months. So there is a bill which is to be recovered after 6 months. Against that, they can go to the bank and discount it and get some money. This is called bill discounting. Commercial bill market is that, or bill of exchange. There is a promissory note also, because only reputed parties are allowed to participate. Their bills are accepted. Because I told you a promissory note, here I am giving the definition of promissory note. A promissory note is a form of financial instrument in which the note's issuer and note's payee undertake a written promise whereby the issuer promised to pay a definite sum of money either on demand or at a specified future date to a particular person or to the bearer of the instrument. So you can understand it's a mutual understanding that okay, I am borrowing, it's a no collateral backing, another thing, except collateral is bills, uh, not solid assets, bills. These bills are trade bills, commercial bills, inland bills, foreign bills, indigenous bills, and different types of bills. But not power bill and telephone bill and other things. Okay, these will be against some deliverables. Okay, rediscounting of bills is an important segment of the bill market. Here, what happens is that suppose A has gone to the bank and discounted his bill of 1 lakh and got 90,000 rupees and he's continuing his working. Now bank knows that 90 days baad I will be getting 1 lakh if I present that to Indian Railways. In between, bank needs money. So bank can rediscount with another bank and get maybe a little less money. But liquidity will be maintained. So that is why money market short term में liquidity management के लिए this money market facilities are there. I hope I am clear that for liquidity management in the short term, this money market plays a very important role. Next, I come to certificate deposit. This is something different than others. Here, what happens is that I negotiate with a bank. I am giving you a 25 lakh deposit or 50 lakh deposit. Actually, it should be minimum 1 lakh and multiple of that. And against that, bank will give me a certificate of deposit. Now, this is a negotiable instrument. Suppose bank will redeem it only after 1 year, and FIs, financial institutions, if permitted by RBI, can offer it for 3 years. Please note, this is the only variations in the money market. If financial institutions have permission from RBI, they can issue certificate deposit for 3 years. Otherwise, it is limited to 1 year. So now, bank will, suppose I have gone to Punjab National Bank and deposited 10 crores and collected a 10 crores CD, each with 1 lakh. So you can understand now, I'll be having so many CDs. Now I may need to need money of 10 crores का जगह 5 crore. तो 5 crore का CD I can offer to sell in the market, and this is also discount to the face value. So people will buy it at a price in which their interest is affordable by them. So discounting का मतलब है face value is something and I am paying you less than face value. There is no interest payment. So naturally, if I taken 6 months earlier, interest rate has gone up, then the value of the certificate of deposit may be less because people will expect higher interest rate. If interest rate has gone up, certificate deposit value will be high because you will be, even at low interest, you want to get the yield like this. So this is certificate of deposit. So it is against a deposit Here it is clearly mentioned, CDs are negotiable money market instrument against fund deposited in a bank or other financial institution for a fixed period at a specific rate of interest. So when I negotiate with the bank, I negotiate a fixed rate. But subsequently, when it goes to the market, it is as per the market rate. Okay, they are a bearer document. That means जिसका पास हाथ में रहेगा, he can encash it or he can discount it and issued in a dematerialized form. Scheduled commercial bank, not RRB. RRBs are regional rural banks and local area banks are called LAB. And selected all India financial institutions, like I told you, IFCI, CB, NABARD, etc., etc. They can issue CDs. Finally, money market mutual fund. A mutual fund is an investment scheme mostly run by asset management company. Money is collected from many investors and they can invest in the short-term debt funds. So they invest in the money market instruments. So this is a fund which can invest in money market instruments. Okay. So this is how there are different instruments in the money market. Now let us look at the banking structure before going to the capital market. Broadly, now these are very broad understanding of the financial system. You can go in details. I'll refer the books later on. The definition of bank. Banking Regulation Act 1949 defines a banking company is a company that transacts the business of banking in India. Banking means accepting deposit of money from public for the purpose of lending or investing, however, with the promise of repayment on the demand of by the depositor. Current account, savings account, etc. So whenever you demand, you have to get money. With the facility of withdrawal or payment by the check, and also they offer the check draft and other facility for payments and etc. So three functions mainly banks are supposed to do: accept deposit, give loans or investments, and third is payment and settlement system. You can pay somebody by check earlier. Now you have a lot of other payment facilities, but that is one of the very core function of the bank. So if I look at now the banks, now of course there are a lot of other functions have come. Bank issues guarantee, bank issues sell or purchase of securities. Bank sell mutual fund, bank sells insurance. That is called selling of third-party products. Bank remittance of funds, RTGS and other things you can do. Banks offer merchant banking services, ATM services, RTGS and other thing, electronic fund transfer, and dealing in foreign exchange, etc., etc. If I broadly see the structure of the banking sector, RBI is the regulator and banker of the banks, it is called. Below that, all scheduled commercial banks, it should be scheduled commercial banks in India. These are scheduled commercial bank and scheduled cooperative banks. Cooperative bank may each owner has or each member of the cooperative have one vote. Everybody has an equal vote. But scheduled commercial banks are of two types: public sector bank, where government of India has the majority stake. Private sector bank may private companies have majority stake. Then there are foreign banks. Now, technically, these are foreign bank branches. Their head office is in their own country. Like Citibank is in New York, Deutsche Bank is in Germany. It's like that. And we have regional rural banks. These are promoted by one of the public sector bank and the state government in which the regional rural bank operates. They jointly promote regional rural banks. Okay. So this is another credit channel to the rural India. So Reserve Bank of India rolls quickly, we have to go through it. It was set up in 1935 as a private, because that time there was all public private banks. So they had a controller. So they decided and they formed Reserve Bank of India Act 1934. In 35 it became operational. It was owned by the private parties. Okay, by the bankers. And then it was nationalized at 1949 after India got independence. India nationalized RBI and RBI became the central bank of India, like Fed in US, like that. What are the functions? Note issuing authority, bankers to the bank, banker of the government and debt manager. That means if government, I will explain this, we'll discuss this in brief. Banking sector regulator, foreign exchange manager, all foreign exchange ka hisab should be there with the RBI. You cannot keep foreign exchange without disclosing to RBI. Maintaining financial stability, they have development role and regulator of monetary policy. Now, what are these things in general? Note issuing, RBI has the monopoly power with the consultation with central bank and central government. They issue notes, except 1 rupee note. And RBI ensures that both currency notes and coins are available in adequate amount in the country. So sometimes, there are cornering of some type of notes and other things. So RBI try to find out what is happening. And RBI issued currency notes, including rupees 1 note, which is signed by the RBI governor, are the legal tender of the country. ये जाली नोट नहीं है, ये लीगल करेंसी नोट है. If there is any fake note, you have to be very careful of it. Banker to the bank, all the banks in the country have an account with RBI via which banks settle interbank transactions. So क्या है, RBI के साथ हर बैंक का एक account है. So suppose this bank wants to deal with the other bank, they will not go direct to that bank. They will go through the RBI and do the clearing, etc. Okay. At the same time, if they have to maintain SLR or they have to borrow from the bank, RBI will transfer the money in that bank. Or if they have excess deposit from that account, they will transfer the money to the RBI to keep the excess deposit, which you will come to know later on. Banker to the government and debt manager. RBI acts as a banker to the central government. In the sense, if central government wants to raise money, RBI acts as a merchant banker. RBI will issue the bonds or generally or treasury bills. Treasury bills are for the short-term surplus. Salary देना है, गवर्नमेंट का पास पैसा कम है, तो RBI short term में पैसा उठा के treasury bill से they give it to government, or sometime for the long term bonds RBI raise for the government of India. There are scheduled times and other things are there. And it maintains the government accounts and does financial transactions from the account along with transfer of government funds. It manages the government domestic debt and raises the money both from public and financial market to bridge the shortcoming of revenue. So when you find the budget pace, there is a shortfall of revenue. So that revenue shortfall is the money RBI raises from the market as well as the financial market or from the public. Besides that, RBI is the regulator of the banking sector. You all know. Foreign exchange manager, RBI is the custodian of foreign exchange reserves and gold reserves in the country. Actually, gold reserve in the sense, excess money RBI का पास जो रहता है, that they convert into gold or some other foreign exchange reserve, and they maintain that gives the solidity of the foundation strength of the central bank or RBI in our case. And both the development and regulation of foreign exchange market is an important function of RBI. So anytime if you are exporting or you're importing, you have to deposit. There is a time you can keep the money, but after that you have to deposit with the bank. And through bank, RBI comes to know that this much foreign exchange we have. It may not be in the RBI treasury, it may be with the banks, authorized dealers, etc. But RBI is the de facto custodian of that. I hope I'm clear. RBI is the de facto custodian of this foreign exchange. Without RBI's permission, you cannot do much except where RBI allows you. If RBI has given a permission, $200,000 you can transfer to US, buy securities, buy home, etc. Then up to that, you can go to the bank and withdraw dollars and remit it to US and do something. But beyond that, you cannot do. Next comes the development role. Now, naturally, being the banker of the bank and central bank, it has a big role in the developing economy to increase the financial literacy, educating people about the jali note, proper note, how to save, why you should have a bank account, why should you try to get interest. You should not borrow from the money lender who charges you more. You should try to borrow from the bank. It's a different thing. RBI has established many institutions like NABARD for the rural and development and reconstruction, National Housing Bank for housing development, Deposit Insurance and Credit Guarantee Corporation may RBI assures up to 5 lakh as of now. Deposit if you do with the bank, it is secured. RBI will return in case bank dissolves. Besides that, RBI has a lot of training and research center like Center of Advanced Financial Research and Learning, Indira Gandhi Institute of Development Research, National Institute of Bank Management, where they train and do research on the macroeconomy, how we can have economic growth, etc. Regulator of monetary policy. Now, monetary policy is a short-term money management policy. RBI, now there is a monetary policy committee, but it is RBI ka three directors and outside directors. Veto power lies with the governor of RBI. They decide the monetary policy. There is a quantitative aspect, there is a qualitative aspect. We'll discuss this in details later on. Now, quantitative also quantitative. So there are certain monetary measures like cash reserve ratio, quantitative measure, statutory liquidity ratio, refinance facility, how much I will refinance the exporter or importer, then bank rate, repo, reverse repo rate, liquidity adjustment facility, open market operation, market adjustment. These are all indirect instrument. So first, direct tools are cash reserve ratio, statutory liquidity ratio, and refinancing. So what is cash reserve ratio? It is the minimum amount that banks keep with the RBI as a proportion of their net demand and time liability. Here I will just take a little time. Net demand and time liability matlab your current account and savings account deposit are demand account and recurring or fixed deposit are time liability. Against that, sometimes you take loan. That is why net demand and time liability. So if your net demand and time liability is 10,000, so 10,000 to 3%, so 300 crores you have to keep cash in your treasury or wherever your treasury branches are. So as of now, March 26 May, CRR rate is 3%. The 3% of NDTL you have to keep. This is how security banks maintain करते हैं. Statutory liquidity ratio is the percentage of NDTL how I have to maintain in approved securities. Liquid asset, maintain in safe and liquid asset like cash, gold and government securities. So क्या होता है? This money I cannot lend. I have to, because if any crisis happens, I can sell these securities and pay my depositors. This is called statutory liquidity ratio. Now it is 18% as on March 26. Refinance facility is adequate credit to selective sectors like export sector, or I am giving loan to agri sector at a lower rate of interest. So RBI refinances me so that I can carry on my business profitably. That is it. So these three are your direct tools for quantitative method. Next, I come to the bank policy rate. As RBI Act 1934, bank rate is the standard rate at which RBI is prepared to buy or rediscount bill of exchange or other commercial papers eligible for purchase under this act. The bank rate has been aligned to the marginal standing facility and it changes automatically when marginal standing facility changes. I'm going too fast. So marginal standing facility is that if any bank is in a crisis of money, there is a window through which they can borrow from the bank. Or RBI will discount their bills and give them the money, etc. Now, beside that, we have often heard about the monetary policy with the repo rate and other thing. Repo rate is when RBI lends to the bank overnight to adjust the liquidity, and monetary policy committee decide the rate. Present rate is 5.25%. Okay, so if banks is against a approved securities, okay, collateral is approved securities. Present rate is 5.25%. So if bank wants to borrow from RBI, 5.25%. Reverse repo is reverse. Suppose bank has a lot of money, but they don't have a loan or other thing. So, but they have to pay interest on the savings account or other thing. So they can keep the money with RBI. RBI pays them 3.35 as on March 26. These two rates can change depending on the monetary policy committee's recommendation. These are the liquidity adjustment facility introduced by RBI after it was suggested by Narasimhan committee. The repo rate, reverse repo, term repo auction, overnight variable rate repo rate, overnight variable rate reverse repo are components of liquidity adjustment facility. Liquidity means how much money should remain in the system, because उसका ऊपर डिपेंड करता है inflation और money tightness. So another three functions है open market operation. RBI can buy government bond. See, RBI will buy government of bonds from the market. That means RBI is buying government of bond from the market. RBI is getting the security, and liquidity is going to the bank. Banks are getting money. Otherwise, RBI will sell security. Bank will buy, so bank will pay to the RBI. So this is the two way RBI can manage how much money should be there in the system. Market stabilization scheme, also market stabilization bond was introduced in 2004. And then there is a marginal standing facility. I told you the rate is presently 5.50. Okay, this is March 25 ka rate, 26 ka rate. Functions of the RBI control, as I told you, qualitative method ho gaya. A quantitative method we have mentioned about यहाँ पर we have a fixed quantity 8%, 18% SLR, 3% CR and everything. Qualitative में credit rationing. I can tell that recently RBI has said personal loan कम करो. Don't give personal loan, or personal loan should not be more than this amount. These are credit rationing. I can tell agriculture में you increase the credit. These are way I can indirectly direct credit to a particular segment of the economy. Moral suasion. Sometimes RBI will not give a policy direction or order, but they will request or they will persuade commercial bank. The time is not good. Be cautious. People are taking money for traveling loan, which is now unsecured, going to Mauritius, coming back. His job is unsecured. You may not recover the money. So be careful giving this loan. And direct action is sometimes RBI directly asks some banks, because you are not following my direction, so you cannot lend. So this is RBI's some policy direction. RBI can take penal actions. Okay, there was a time when RBI, 11 banks ko RBI stopped giving credit. In the sense, RBI asked them that they cannot give credit because they had a lot of non-performing assets or default account. Scheduled Bank of India, you know there are different type of Scheduled Bank of India. The definition is that they should be listed in the second schedule of RBI Act 1934. Second schedule of RBI Act 1934. Bank should have a paid up capital reserves of not less than 5 lakh. This is the old act. Actually now it is 500 crores. These need to be maintained CRR balance with RBI. They can get scheduled commercial bank only get the facility of repo, reverse repo. They have to maintain SLR, CRR, etc. Now, public sector banks are where government of India holds more than 50%. As of 2025 December, there were 12 public sector banks. There were more, but they have been merged. Like Punjab National Bank has been merged with United Bank of India and Punjab and Sindh Bank. And Punjab Bank of Baroda has been merged with some banks. SBI has merged with all the SBI associate banks. So now we have 12 public sector banks. Private sector banks case, there were some old private sector banks which were not nationalized, and there are new like Axis Bank, ICICI Bank, etc. They are new private sector bank. Beside 2015-16 May, we came out with two types of banks. One is small finance bank and one is payment bank. So taking all together, we have now 21 private sector banks. These are owned primarily by private companies, private parties rather I should say. Foreign banks, now they are branches, as I told you, with a headquarter in their own country. And as of now, 2025 May, we have 44 to 45 foreign banks operating in India. Now, rather foreign bank branches will be the right word for it. Regional Rural Bank, I have told you, this is established in 1960 as additional channel to credit structure. As of 2025, there are 28 regional banks in India. Beside that, we have cooperative sector in which we have scheduled cooperative banks, function on the concept of cooperative credit societies, where members of the society join to extend loan to each other at a subsidy rate of interest. There are two types of state cooperative banks: scheduled state cooperative banks, which are generally government has a power and authority, and scheduled urban cooperative banks. As of now, there are 23 scheduled state cooperative banks and 53 scheduled urban cooperative banks. Now, these are very loosely managed banks. That is why RBI is trying to reduce or becoming very strict. So this is what we talked about the bank. So we have covered about the money market. We have covered about the banking structure broadly. Now we are coming to the capital market. So far we have studied about the money market, which provides short-term funds to the investor for less than 1 year. However, business units and investors need funds for longer duration, also for undertaking business expansion and technology upgrading. And in this, say I need 2000 crores for 5 years because I have a big power project. Where do I go? I bring in my money, promoter's contribution. The balance I can go to the bank, or I need to go to the some capital market. Bank may not be able to provide me, or I may not be liking. I can get from the market at a competitive rate. So we need another market that is called capital market, where I can get long-term fund, equity as well as debt. So capital market is a market for long-term securities or financial instruments. So both are called. It's called long-term security also, financial instruments also. Having a maturity period of more than 1 year. Capital market are channelizing savings, capital formation, industrial growth. So now here I am giving a broad picture taken from your notes. Capital market, primary market and secondary market. There are instruments, financial instrument, quite quickly, broadly, share, bond, debentures. Then intermediaries are there, merchant bankers, sub brokers, registrars, etc. Regulator is SEBI of the capital market. Primary market is also known as new issues market, NIM, where the issuer of securities, shares or bonds or debentures, sell the new securities to the investors. They are called IPO, initial public offering. Secondary market is also known as stock market. So generally when we call stock market, we call the secondary market. We don't talk about the total capital market. It is a place where shares, bonds, etc., which have been issued earlier, are sold and repurchased because people need an exit, and those who could not subscribe during initial public offer, they want to buy. So that is why there is a need of secondary market. Now, financial instruments. Share. Let's call it a simple product, ordinary share. A share indicates a unit of ownership by the buyer of the shares, called shareholder or owners of the company. A shareholder has ownership in the company and has voting rights. For one share, he will have one vote. If he has 1 lakh share, he has 1 lakh votes. Unlike cooperative, where even if you have 1 lakh units, you will have one vote. Shareholders ownership, and they have to share the profit and loss. So it's called residual earning जो company का है. If it is profit, then profit is loss. That has to be borne by shareholders. Time to time, shareholders also benefit from a company's profit when they get dividend. So if the company is distributing part of the profit to the shareholder, it is called dividend. Beside that, the share price may go up, that is a capital gain. So a shareholder can have two types of benefit by investing in share of a company. One, it can get dividend from the company, which is a share of a particular year's profit, or capital gain because the market value of the share goes up if the company does well. So that is why the shares are very much in demand, though they are a little risky because they are also supposed to bear the loss if the company bears loss. Bonds are issued by state and central governments. Municipalities, companies, sometimes they name it bonds, but technically companies issue debentures. So bonds are issued by central government, state government and municipality. Municipality bonds are called muni bonds in short. to raise money for various projects or activities. They are debt instrument in which the entities borrow the funds for a defined period at a variable or fixed interest rate. So different types of bonds are there, mostly fixed rate of interest. There can be floating rate of interest. That means they will be linked to something. And then suppose I say that okay, RBI का जो repo rate है plus 2%. Then it is floating rate because RBI's repo rate can change depending on the monetary policy stand. So you will get abhi 5.5 repo rate hai, 2% I will give you more, you will get 7.5% interest. If repo rate comes down to 5, you will get 7%. And sometimes it is zero coupon. That means I issue 25,000 and after 25 years I will redeem it at 1 lakh. So I will not give any bonds. Treasury bills is it's not a bond, of course. It's something like zero coupon. There is no interest payment. It is only the capital gain you get. Now, bonds are generally unsecured but guaranteed by state or central government. Debentures, on the other hand, if it is less than 18 months, it's maybe unsecured. But if it is more than 18 months, it has to be secured by the mortgage of the plant, machinery, etc., or other assets of the company. So, our debt instrument, which is issued by companies for raising funds, they are not. They are secured by physical assets or collaterals. Not is wrong. It's by mistake. Secured by physical assets or collaterals. An investor buys debenture based on reputation and the creditworthiness of the issuer, and the interest rate on debenture is higher than the bonds, and debentures are to be rated by rating agency. Any rating agency approved by SEBI has to compulsorily rate the debentures AAA, AA, like that, and then only they can come into the market. Again here, if the debenture issue is of beyond a size, then there should be two rating agencies, they should be rating the debenture issue. There are different types of debentures. Non-convertible debentures, money which cannot be converted, they will be strictly debenture redeemed after a particular period. There are convertible debentures. Fully convertible debentures means 100 rupiah ka debenture, maybe it will be converted into 10 shares of 10 rupees each, or 50 rupees share, 2 shares they will get depending on the terms and conditions. Partially convertible debenture, suppose 100 rupees debenture, 50 rupees will be converted into share, 50 rupees will be redeemed at a debenture only. So this is convertible debenture, two types. Again, there can be a zero coupon debenture where I will not pay any interest. You deposit now 500, after 7 years you get 1000. So I can plan accordingly and I can subscribe to these bonds. So these are broadly three types of instruments, and within that there are various variations are there. But as of now, we are learning about the basics of Indian financial system. So these are the main financial instrument into the capital market, right? Now let us look at the capital market intermediaries. Now, capital market, first of all the intermediaries in the capital market compulsorily has to be registered with SEBI, the capital market regulator. Now, SEBI defines a merchant banker, any person who is engaged in the business of issue management, either by arranging for buying, selling, or subscribing to securities, or acting as manager, consultant, rendering corporate advisory services in relation to issue management. So that means merchant banker are basically who helps the companies, guides them, and manages them to raise money from the public. Okay, IPOs. So there will be, depending on the size, there can be one merchant banker, there can be multiple merchant banker. Then there are underwriters. When I am issuing, suppose 500 lakh shares, may not be fully subscribed. So I need somebody who will give a comfort level that, okay, if it is not subscribed, then I will subscribe. They are called underwriter. And for that, they will charge an underwriting commission. Then comes the stockbroker. Actually, we have seen that when we want to buy or sell markets in the secondary market, we have to go to a stockbroker. So stockbroker is an individual or firm which is an intermediary between an investor and the securities exchange. So National Stock Exchange, Bombay Stock, BSE India are the main two stock exchange. We have also M6 India. The stockbroker trades in the stock exchange on behalf of their clients. In return of their service, they are paid commission or fees. So these are the key. Beside that, you have registrar, you have depository participant, and you have transfer agents like now. You have sub-brokers or authorized person through which they are capital market intermediaries. Regulator of the capital market in 1992, SEBI became, after the act, SEBI Act became the regulators with statutory power of the capital market. Their main object is to protect the interest of investor and development and regulation of the stock market. They also prevent deceitful malpractices, that is insider trading. Some brokers or some investor are trying to manipulate the price, that they are supposed to prevent. And third is regulate and develop a code of conduct for intermediaries. I told you all brokers, underwriters, everybody should be registered with them and to develop. And finally, there is one point has to be noted. SEBI's also role is a development role like RBI for the money, SEBI's for the capital market, for awareness, and so that now they have an exam also, so that if you want to go to the capital market, if you write for that exam, you will have a basic idea about the capital market, then you should participate in the capital market. So these are the capital market intermediaries. To sum it up, today we have covered Indian financial system broadly. We have understood the role of financial market by borrowing the savers and those who want the money to set up an industry or borrowers. Then we have understood the financial market. There is a money market, there is a monetary policy, and how RBI is controller of the money market, and through CRR, repo rate, reverse repo rate, bank rate, they manage the short-term liquidity of the market and in the process, the inflation in the economy. In the next section, we developed an understanding of the banking structure in India. Public sector bank, private sector bank, new private sector bank, old private sector bank, state cooperative banks, urban cooperative banks, etc., as well as foreign bank branches in India, structure of banking in India. And to some extent, RBI's role also we came to know. What is RBI's role in the Indian banking system? Because RBI is the regulator of the bank. Followed by that, we have covered the capital market. Financial market, the last leg, the capital market, in which we have understood what is capital market, what are the various instruments, what are the intermediaries, what are the regulators' role, and etc. So with this, we come to the end of today's Unit 5, and I hope we have met a basic understanding of Indian financial system, in which there is money market, capital market, as well as Indian banking system. Thank you. I am Professor Binodgopal Mukherji.